The hidden M3, how Treasury buybacks and stablecoins are rewriting the yield curve. Flint West reporting, coming at you from the fault line where debt and money blur into the same damn thing. Everyone's watching the Fed talk rates, everyone's screaming about deficits, but nobody's looking at the plumbing, the yield curve. That line on the chart isn't just interest rates. It's a map of who's keeping America afloat and how fragile the whole machine has become. You think the US government is managing debt? No, it's juggling knives in the dark. On one end of the table, 30-year bonds nobody wants, sputtering auctions, foreign central banks walking away like a bad date. In the middle, the 2 to 10-year belly, cheap on paper but fragile as hell. One inflation print and it all goes tits up. So where does Treasury run? To the short end, to the bills. Because bills have buyers who don't get a choice. Money market funds, repo desks, corporate treasurers, and now the new muscle in the room, stablecoins. They all must hold bills, whether yields are 4% or 1%. Collateral isn't optional in the plumbing of the dollar system. It's survival, and that's the punchline nobody says out loud. Bills aren't debt anymore. They're money. The hidden M3 of the American empire, a shadow money stock as large as the deposits in every bank account in the country. Who buys what? U.S. Treasury yield curve demand map. Look at this curve. On the left, bills, $6 trillion worth, hoovered up by money market funds, repos, stablecoins, and foreign reserves. That's the collateral backbone. In the middle, notes, $11 trillion. Banks, corporates, hedge funds nibbling but cautious. One inflation flare-up and they puke it all. On the right, bonds, $3 trillion. Pensions and insurers clinging on, foreigners drifting away. That's the long-term credibility anchor, rusting in real time. That's not a yield curve, that's a map of desperation. Each sector buying what it must, not what it wants. See, the Treasury calls this buybacks. Makes it sound tidy, even prudent, like paying down your mortgage early. But that's a fairy tale. They're not paying debt off. They're swapping long-term pain for short-term convenience. Retiring 30-year paper with one-year bills. That's not fiscal discipline. That's using a payday loan to cover the rent. And it works until it doesn't. Because when you live in the short end, you're always rolling the dice. Bills come due every month, every quarter. You've got to refinance constantly. One failed auction, one liquidity shock, and suddenly Uncle Sam's standing hat in hand, begging the very system he built to roll him over. Why risk it? Because it's the only place left with buyers who cannot say no. The long end has walked away. The belly flinches at every inflation print. But the bills? They've got a structural bid baked in. Money market funds need them. Repo desks need them. Stablecoins, hell, stablecoins are a whole new machine. They're eating up Treasury bills like candy because regulators anoint them cash equivalents. You don't argue with the plumbing. You just pay the toll. And here's the kicker. When debt turns into money, you're not running a bond market anymore. You're running a shadow monetary system. The hidden M3. The real money stock isn't just bank deposits. It's treasuries themselves, circulating as collateral, as stablecoin backing, as the bedrock of the dollar. You wanted the quantity theory of money? You're looking at it. M times V equals P times Q doesn't stop at deposits. It's got 20 trillion in government IOUs strapped on top, moving like cash. But that foundation is brittle. Every inch of it depends on confidence, that the rollovers keep rolling, that the auctions keep clearing, that the bills never stop finding a bid. The minute that inelastic demand wobbles, the whole facade cracks. What's safe when the safest asset in the world has to be propped up with buybacks, leverage ratio loosening, and digital tokens? The Treasury thinks it's buying time, but what it's really buying is fragility. The more they stuff into the short end, the more the system becomes a treadmill, running faster and faster just to stay upright. And there's no exit ramp. Not when debt is money. Not when the world's reserve asset has become the world's rollover risk. That's where we are. A nation financing itself on 30-day paper and calling it management. A curve that isn't a curve anymore. It's a triage chart. And a treasury market that's no longer just debt, but the hidden M3, the parallel money supply underwriting an empire too scared to look past the next quarter. So here's the truth. America isn't managing its debt. It's surfing a wave of short-term paper, praying the tide never turns. Bills have become the backbone, stablecoins the new demand engine, and the yield curve the triage chart of a system running out of safe exits. That's the hidden M3, the shadow money supply that props up an empire one rollover at a time. Flint West signing off. Stay sharp, stay liquid, and never mistake engineering for safety.